All right, guys, the next person I'd like to bring to the stage is a very good friend of mine. He is a real estate expert, to say the least, in residential real estate. His name is Jason Hartman. So if you'd all join me in welcoming him to the stage.
George, thank you. Thank you. Oh, appreciate it. Good morning, rebel capitalists. How are you? So are you all rebels? Yes. Yeah, well, listen, the thing today is that being a rebel should be the mainstream thing. Right. We are living in a time of unprecedented oppression, economic oppression, and repression of all kinds of our freedoms. I mean, we are under attack, folks. This has probably never even been considered that this would happen in America. In this great country with the vision of our founding fathers, we have got to defend ourselves, and that's what we're here for this weekend. So let's first start off by thanking George, the visionary, the man who put this on. And George, thank you. I don't know where you are, but... How many of you were at the Miami event about 6 months ago? Yeah, awesome. Okay, good. Well, you saw my talk at Miami, and we're going to include a little bit of that, an update on the Hartman Comparison Index today. A lot of you at the cocktail party were asking me about it last night, so we'll give you an update on the index. But there's a bunch of new stuff, and I have had to ruthlessly cut slides out of this presentation because I only have 3 hours with you this morning. And so we'll go until lunch. Just kidding. Just kidding. But there's lots more, of course. You've seen me on George's YouTube channel. Maybe you watch mine, and I've had George on my show many times, and Lynette's been on, and Mark Moss has been on, and many of the other speakers here this weekend. So check that out for more info. When I first came in on Thursday evening, I met Jake from Toronto. Jake, are you here? Where are you? I can't see the audience, but I think you're here somewhere. And he said that he drove here 27 hours because all of these flights are just a fiasco, and the airlines are, of course, using weather as an excuse. I mean, weather is legitimate, right? But they're making more out of it than it should be. It's kind of like saying a cold or the flu is a legitimate thing too, but they're making more out of it than is reality, right? So he said he listened to my podcast all the way here, so I so much appreciate that. And that main podcast is called The Creating Wealth Show. So you can hear George on there and a bunch of other people here. Of course, George and Ken McElroy and I started the Collective Mastermind just before the Miami event. And we had our first event. Of course, some of our collective members are up here. Winston, of course. Winston took 5 flights to get here, if you can believe that. Now that's dedication. Awesome, man. And Gary and everybody else. So I'll be hanging around at the collective booth a little bit this weekend. So if you want to find me for any questions, I'll be there. But let's get into some predictions. Now, predictions are a dangerous business, right? Because you're gonna stick your neck out. And you might be wrong, of course. You might be wrong. That's the problem with predictions. So I'm going to make a few predictions and stick my neck out, but I really want to give you the data to do your own thinking about this. And we'll just look at some raw data to see what's going on in the marketplace, the real estate market specifically, but it also clues you into the broader economy, of course. So let's look at some of that. Let's start off by talking about where we are now. If you don't know where you are, it's very hard to forecast the future. Yogi Berra, he had some great quotes. He said, "The future ain't what it used to be," and there's no question about that. One of the things I always say on my podcast is you must watch old TV shows, watch old movies, listen to old music, and read old books, because so many people, and especially younger people, and you can't blame them because they've been listening to revisionist history in school, and especially in these disgusting universities that are, it's just so warped, it's unbelievable how history is just being revised. But the thing that doesn't lie is just watching old movies, old TV shows, reading old books, and listening to old music. I always have had this theory that the peak of civilization, anybody want to guess what year that was? You notice I say was, right? The peak of civilization. Shout out a guess, anybody. What do you think that was? Okay, 1990. Someone's listening to me, or you guessed that. Yeah, I think it was 1990. And if you think about that, the 80s was this, decade of prosperity. Of course, if you listen to the lefty media, they'll say it was unprecedented greed and terrible capitalism. That's so evil, capitalism, But yeah, 1990. After that is when the music really changed. And of course, we all know that quote from one of the Rothschild family members, I think it was like Baron Rothschild or something, that said, "Let me control the money, and I care not who makes the laws," right? That's, we all understand this as rebel capitalists, right? We understand how important the money is, right? When you control the money, you control so much. But I put a corollary on that. Let me control the music, and I care not who makes the money or the laws, right? Now, I obviously care about those other things, but it's a quote, right? So you gotta give a little latitude to it. So things are changing fast, and I just encourage all of you to remind yourself and remind the people in your life of how life used to be quite literally just 2 years ago, and 10 years ago, and 20 and 30 years ago. It has changed radically. The standard of living for the vast majority of people, except a small number of elite kleptocrats, has just declined massively. I mean, it is, now technology hides this. Importing cheap goods from China hides this. Importing cheap labor from Mexico hides this. But when you really look at it and you peel the layers of the onion back, the standard of living has declined massively. Now, COVID, of course, COVID-1984, has given an excuse to lots of businesses to just massively cut back on services. Hotels don't clean your room every day anymore. Valet parking has all but disappeared in lots of places. I mean, this is called skimpflation. We've all heard of shrinkflation, right, where you just get less and less. But there's also skimpflation, how you get another way you get less and less. And we're all doing things for ourselves all the time nowadays. I mean, everything is do it yourself. Do you ever wonder why you have, I have a feeling you all suffer the same thing that I do. You have all these frustrations all day long because you're doing everything yourself. You're dealing with every do-it-yourself website. All of this stuff used to be done by people that provided services to us. There is no more service. You go to a restaurant now, and all these hip, cool new restaurants, you walk up to the counter and place your order, and then they give you a number and maybe they bring your food, right? Or maybe you have to come up and get your food as they shout your name or number out. So shrinkflation, skimpflation, this is all the standard of living that has just been declining and declining and declining. Yet at that same restaurant, you're expected to leave a tip. Yet, where was the service, right? It's just amazing. Just notice all of these things that didn't used to be that way, right? It's all just massively changed. Okay, so where are we now? Well, this is housing inventory. So housing inventory, the experts will tell you that the normal amount of housing inventory, and by the way, this is from Altos Research. How many of you heard that podcast I did with them or saw the interview on YouTube on my channel? This is the housing inventory. We are literally starting the new year with a record low housing inventory. If you look at it on a per capita basis, housing inventory is literally 1/5 of what it should be. So, one metric would be this one. If you are thinking the bubble is about to burst or there's going to be a crash, you better see housing inventory increase by 500%. Because a normal market is 5 times this amount of inventory. That's only normal, not a recession. So if we're on the way to a 500% increase in housing market, to have a balanced market, what's considered equilibrium, then that would be the sign of a bubble about to burst. So in terms of inventory, it's looking like prices are going to keep going up, up, up. okay? It would be like this. And amazingly, now this is not a picture of Venezuela, right? We've all seen this in the US. We certainly saw the toilet paper shortage, right? But the shortage of everything. It would be like walking into the grocery store and seeing only 1/5 of the shelves stocked. That's the housing picture today. But wait, there's more. As they say on late night TV when you can't sleep at 2 a.m., right? But wait, there's more. This housing inventory does not really tell you how acute and how bad the story is. Why? Because that's just overall inventory. If you look at the housing inventory in the entry-level segment, it is insanely bad. And I don't have a number for you, but I'll just give you the anecdotal data. Okay, when our clients, I mean, what my company, my real estate company does is we help clients buy rental properties nationwide. We help them build portfolios of rental properties. Some people come in, they buy one property, maybe they buy one a year, right? Some people come in and they buy dozens and dozens of properties. We've got one client now, I think he's up to about 120 some odd properties that he's purchased through us. He wants to get to 500 doors, okay? And these are single family homes, the vast majority of the time. There's some duplexes and fourplexes in there, but mostly single family homes. So the inventory is a significant problem. And in the rental housing market, that entry-level market, that affordable, whatever that means, house, it is much, much worse than the 1/5 problem, with inventory being 20% of what it should be. Okay, so there's just another way to look at it. But wait, the brilliant people at the government figured what they should do to solve the housing problem is instead of working on the supply side of the equation, because they're completely incompetent, they would work on the demand side as if there's not enough housing demand, right? These brainiacs decided they would increase the loan limits. On conventional loans, they just increased the loan limits by 18%. On FHA loans, they increased the loan limits by over 15%. Now, it depends where. It's different around the country. By over 15%. Now, the comparison, because life's most important question is, compared to what? The comparison is, what do they usually do on an annual basis in terms of increasing loan limits? Well, last year, they raised the conventional loan limit about 7%. So it's more than double. In expensive areas of the country, a first-time buyer can get an FHA owner-occupied loan up to $1 million, just about, it's slightly under, but about $1 million. And all they need is 3.5% down. Now, years ago, when I started in the business, when I was 4 years old, the FHA loan limit was $91,000. It's increased by a factor of more than 10, okay? This is throwing gasoline on the fire. This is increasing demand where we don't need any more demand. We need more supply. Instead of incentivizing builders and relaxing zoning laws so they could build more houses, they're just increasing demand. They do the same thing with college tuition. These are the incompetent people running our world, right? It's just incredible. Where are we? Well, last year, the average home equity, according to CoreLogic, increased by about $57,000. So people have a lot more equity than they used to. That's over 31% increase, about $3.2 trillion in equity increase. Do you know that 40% of the homes in the country have no mortgage whatsoever? Now, if you follow my work, you know that that's a bad idea because it doesn't take advantage of inflation-induced debt destruction. But hey, it does make the market far more stable and robust because people with no mortgage have a very difficult time getting into trouble and getting foreclosed on, right? It can happen. They can foreclose based on property taxes, for example, or HOA not paid, right? And some of this equity if we go into a bad recession, or if we come into a housing crisis, some of it could evaporate. There's no question about it. But just last year, it was increased by 31%. Okay, there it is state by state. So in the Socialist Republic of California, my home for most of my life, equity increased by $119,000. And you might think that's a big deal, but I want you to look at something. I want you to look at Florida, where I live now, the freest state in the country, where they don't even know what a fucking mask is, okay? It's just so funny because I have people that work for my companies all around the country and some offshore around the world. And the Californians, they're like, well, what's it like there? And I'm like, unless you go to the airport, it's normal. It's just normal life. What a concept, right? Yeah. But proportionately, Florida real estate is so much less expensive that a $64,000 increase compared to what? Compared to the overall price of housing is dramatically more than a $119,000 increase in the Socialist Republic of California, right? So just notice that. I just want you to notice that. Okay, let me give you some examples of what happened to a couple of our clients in the past year or so, give or take, okay? He purchased this property in Ocala, Florida, just as George was becoming famous for all of his great whiteboard videos on the repo market, and right before the planned release of COVID-1984, okay? So that's when he purchased this property. And let's look at it in more detail. By the way, if you want to get these pro formas, they're free. Remember that commercial, that old commercial, the Hair Club for Men? I'm going to need that pretty soon. Definitely a problem. Obama, for 8 years, I listened to him talk about how there's no recession, yet my forehead kept getting bigger in the recession. I swear it was happening. Anyway, so you can get these pro formas. The software is free. Just go to propertytracker.com, and you can play with the numbers and put your own numbers in for your own scenarios on properties. It's a great analysis tool. And the Hair Club for Men reference was, I liked it so much I bought the company. Okay, so this I own this now. It's a great piece of software. So he purchased this property back in November of 2019 for $149,900. Okay, and now, well, last month, it's probably worth a little more now. Last month it was worth $231,900. We were selling the same exact properties for that price, $231,900. A lot of our clients have purchased here, okay? He put 25% down on the property, and this is not a theory, this is what really happened, okay? Now, the second part of this pro forma shows you in red there, I've circled the cash-on-cash return of 16% annually. These are annual numbers, by the way. And the overall return of 246%, okay? 246%. See, the thing about income property and why it is the most historically proven asset class in the entire world and the most tax-favored asset class in America is because it's a multi-dimensional asset class. You don't earn your return from just one thing or two things. You earn your return from 5 or 6 things. And the software calculates that for you. So, of course, you get hopefully appreciation, you get positive cash flow, you get tax benefits, you get leverage and equity buildup, and the tax benefit is depreciation, the most wonderful tax benefit ever, which is a phantom write-off. Yeah, you love that, don't you? Isn't that, depreciation is the holy grail of tax benefits. Because, and here's why. Look, when you buy a property, don't really consider it like you're buying one thing. Consider it like you're buying 2 things. You're buying the land, and the land will always be there. So the IRS doesn't allow you to depreciate the land. But you're also buying the structure, the second thing, the house sitting on the land or the apartment sitting on the land. And the IRS has given an economic value, a lifespan to that structure. And with residential real estate, it is the shortest schedule. With commercial real estate, it's longer. It's like about 20-something% longer on commercial real estate. But on residential real estate, it's 27.5 years. So the IRS in their infinite wisdom of the math they do, which is basically dictated by a bunch of lobbyists who lobbied Congress, okay? They say that the house will fall to the ground in 27.5 years and be of no economic value whatsoever. So they let you depreciate, instead of taking that deduction all at once, they let you depreciate 1/27th of it every year. And here's the beauty of that. The property could be producing positive cash flow, appreciating in value, and everything's going great. And you think, wow, this property's a total winner. I got a huge return. I mean, Brandon got 246%. Let's go. But the IRS, the way they look at it like you're losing money. You're getting this depreciation, and it's a phantom write-off. It's a non-cash write-off. Mostly, if you want a tax deduction, you have to write a check. You have to spend money. How many of you have your own business? Right. So, you can have more business expenses. You could hire some people, spend some money on advertising, buy some equipment, and you could deduct that. Or you could donate money to charity, right? And you could deduct that. But here, you didn't write a check. In fact, it's so much better. The initial check you wrote to acquire the property was only maybe 20% of the value, and the bank paid for 80% of it. So it's a pretty incredible asset class for sure. Okay, so here's, that software is free. You can do all these performances yourself. And by the way, back in 2004, when I discovered this software and I got out of the traditional real estate business, and in 2005, the deal finally closed where Coldwell Banker bought my traditional real estate company in Southern California. I was working on getting into the investment side of the business, my first love way back then, and I discovered this software, Property Tracker. And one of the ways I got really good at understanding investments was by simply using this exact software and changing the numbers around and running different scenarios and saying, hey, what if the property has no vacancy in the first year? What if it has 2 months of vacancy in the first year and things don't go so well? How does that influence the overall return on investment? What if it appreciates at 3% or 6%, or like last year, depending on where you're talking about, 17 or 20%, right? What happens? What if the rent is higher or lower? This is how you become a really good investor in analyzing a deal. And there's a great video that's only 30 minutes long, and it's free. It's on the front page of my main website, jasonhartman.com. And you can get this video at jasonhartman.com, and it will lead you through analyzing a real estate deal. If you don't watch or learn or read anything else about real estate, just watch that free video. 30 minutes, really become an expert. And it uses this performance to help you analyze it. Okay, so here's another example. This is David Nelson. He does live in the Socialist Republic of California, but is moving to Idaho like everybody else from California. So he bought this property, he and his wife Gina bought this property in just less than a year ago. I mean, just slightly less than a year ago. It's in Montgomery, Alabama. And here's how that deal looked. They paid $142,000 to buy it. And as of last month, it was worth $169,800. Okay, that's not like incredible, like Brandon's deal. But here's what it looks like. And this is just a few days under a year. Okay? 14% cash on cash return and 108% overall return on investment, because it's a multi-dimensional asset class. You earn your return in many ways. And use the software to really become an expert at understanding that, and watch that video at jasonhartman.com. Okay, now, I want to tell you that I may sound optimistic today, but I am under no delusion that we live in a real economy. It is a house of cards, it is a Ponzi scheme, and that's Charles Ponzi right there, okay? That's the man himself, Charles Ponzi. Boy, study Charles Ponzi. He was an interesting character for sure. So, the economy is fake news. But the real question is, compared to what? What other country doesn't have an economy that's fake news? That isn't a fiat system? That isn't built on a house of cards? So in comparison, I think the US is in a very enviable position. And frankly, I think it's going to maintain that position for a long, long time. People are welcome to disagree with me. Many think, oh, China's going to take over the world. And hey, China's making some good moves. And that's been an impressive story. But China has a giant, giant demographic problem that will start to really be felt in 10 to 15 years. You cannot have a country without people. Tell that to Japan, tell it to Russia, and tell it to Western Europe. Actually, tell it to the Western world in general, which has essentially been committing suicide for decades by not replacing itself. Fertility rates in Western Europe are like 1.1% in some countries. Just to break even, to maintain the current population, every woman has to have 2.1 kids. That's homeostasis. That maintains the rate, okay? So go home and get busy and have some kids, okay? Yeah. That may be the best advice I gave you all day, huh? All right. So the Western world is going away. Russia's going away. China is on its way to going away due to their idiotic one-child policy. And they have a lot of single males that will never have a chance of getting married. In Japan, it is so weird. And by the way, I love Japan. I visited Japan years ago with a Young Entrepreneurs Organization. What a great place. The people are so polite. It's just such a neat country. But in Japan, it is so weird that women are having weddings without a husband. Yeah, no groom. Not even a robot. No. They're buying a dress, they're hiring a photographer, and having a party. Like Dennis Rodman marrying himself. Remember that? Okay? Yeah, that's what it is. That is just super weird. It's crazy. It's really weird. So look, our economy is a house of cards. It's a fiat system. It can't last forever. But the question is, how long can it last? I would bet you it can last a lot longer than you think. I would bet you that with 12 aircraft carriers and the largest military the human race has ever known, and the biggest brand in the world, and the choicest piece of geography in the world, the United States, separated by oceans, protected, can last a very long time. Okay? The guy that founded Stratfor, read his book The Next 10 Years, and then even better yet, read his other book The Next 100 Years. The US is going to control the seas, and when you control the Navy, you control the world, pretty much. You can project power anywhere on planet Earth very, very quickly. So I get it about all the bad things. We're definitely in decline, but that decline can take a lot longer than we can live. Okay? So, just understand that comparison. That's all I want to say about that. Okay. All right. So we live in a kleptocracy. Sadly, it has become an environment where the elites, whether they be the politicians or the corporations who are in bed with them, the lobbyists, they are screwing the citizens. And I'd say one of the big moves toward that was Bill Clinton and NAFTA, and letting China into the WTO. Okay, these were like big steps towards selling America down the river. And of course, they did these things because they could hide real inflation. That's how they hide real inflation, is by importing cheap labor and importing cheap products. And that is obviously changing in the geopolitical environment we're in. But don't worry, we can learn from these people, these kleptocrats, because as Jim Rohn, one of my great mentors at age 17 that I discovered who changed my life, he said, success leaves clues. And these great investors, these elites, we can learn from them. Just look at the investment returns of some of these elites, and let's see if we can duplicate them. Let's see if Brandon or David, the examples I just gave you, could beat them and beat their returns. There we go. Nancy Pelosi's number one. Yeah, she beats every hedge fund manager. Everybody George interviews on his Rebel Capitalist show, Nancy Pelosi is by far the best investor of all. Because, of course, she has insider trading knowledge, right? 69%. And by the way, follow this Twitter. It's pretty interesting. This is the Nancy tracker. It posts all of her trades. So if you want to learn how to be a great investor, Nancy Pelosi is your model. She's a criminal. I mean, this is unbelievable, this woman. And she makes no bones about it. I mean, she just doesn't apologize, just has no remorse. Yeah, if you could get a $193,000 a year salary and have a net worth of almost 200 million bucks, that ain't bad. That is pretty good math. Good job. But don't worry, the other people running the world, we're in good hands. You know, in 2008, Uncle Helicopter Ben, he said, we're not forecasting a recession. Then we went into the biggest Great Recession in over 7 decades. But then Janet told us, I don't believe we'll see another financial crisis in our lifetime. And that was 2017. And she's behind the big CBDC movement and the unified global tax structure. She is one of the big people behind the idea of you can't vote with your feet, no place to run, no place to go. They are trying to shut the door on all of these options globally, and we got to be very conscious about this. 15 European countries are developing an e-euro right now, their CBDC. 5, of course, we know what China's doing. I won't even talk about China. They're the leader in the CBDC, and they're going to tie it to social scores and all kinds of stuff. You know, 5 countries have already launched their own version of D-cash, digital cash, and the digital dollar is certainly coming, and they are going to be able to exercise an unprecedented amount of control over all of our lives. So you got to have a plan B, because, I mean, just imagine the world that probably seems crazy now, maybe after the last 2 years it doesn't, or maybe after what happened January 6th a year ago, it doesn't seem crazy because of the insane censorship that's going on. But just imagine a world where you post something on Facebook and the next time you have to pay for your internet access, your CBDC won't buy internet access or phone service, because they have cut you off from communication. You'll have to figure out another way to pay for internet access. And maybe the big companies that are in bed with the government won't accept cash if there's any around, or gold, or anything. The only thing they will accept is the CBDC, the central bank digital currency. So, yeah, this is problematic for sure. And Janet is a big proponent of all of this. I'd say one of the people at the forefront of it. But then there's Jerome Powell, okay? Very unlikely we'll see US or 1970s style inflation again. Hey, guess what, Jerome? We're already there, okay? We are already there. And by the way, this is not even current. You know, at the bottom it says rents 3.5%. Rents went up way more than that last year. So yeah, it's just crazy. So we have arrived at 1970s style inflation. And remember, of course, we all know from George's teachings that the consumer price index is fake news. Okay, it's easily the real inflation rate now, I say, is 14, 15%. No problem at all, right? Do you agree? Yeah. Who thinks, give me the highest inflation number in the audience. Anybody think it's, north of 15%? Real inflation? Yeah, some people do. North of 20%? Anybody? Yeah, well, few hands, yeah, several. All right, so as they are dropping the helicopter money, they are making sure they're taking advantage of the Cantillon Effect. Richard Cantillon, the guy that came up with this idea, would be like 342 years old this year. And he said the people closest to the money get the biggest benefit from the money printing. And that's certainly true. And we see the elites getting the lion's share of it. The concentration of wealth is insane. And if you watch old movies and old TV shows, like anybody, a show I used to like because I thought this guy was really smart was Columbo. You ever listen to Columbo or watch Columbo years ago? Yeah, that sloppy detective that he asked really good questions, Columbo did. And Columbo would go and investigate a murder in the home of some super rich people for the day when the series was made. And the idea of super rich back then compared to super rich now is vastly different. I mean, the wealthy are becoming insanely wealthy, and this concentration is going to make for a very unstable country, unfortunately. A big middle class makes for a stable country, and the middle class is obviously under attack. But don't worry too much, because in the Chinese language, the word for crisis, or the symbol for crisis, is the same as the symbol for opportunity. And literally translated, it means crisis is an opportunity riding the dangerous wind. Crisis is an opportunity riding the dangerous wind. So we can philosophize, we can complain, we can do all of that stuff as much as we want, but at the end of the day, we've got to make our money, we've got to protect our financial futures and protect our freedom ourselves. It's a do-it-yourself project. Nobody's going to do it for us. So I think one of the best things we can do is align our interests with the two most powerful entities the world has ever known: governments and central banks. Can't beat them, join them, right? So in what ways can we do that? How can we do that? One way we definitely do it is through my strategy of inflation-induced debt destruction. Let's just look at this example of home prices, interest rates, and mortgage payments in 1985, 2000, and not even today. They're even lower than that now. So this isn't even current, this little chart I found on the interwebs. But I thought the graphic was good. So if you wanted to keep your mortgage payment under $1,000 in 1985, you could buy a $95,000 house and pay a little over 12%. But what did that feel like to those people at that time? And keep in mind, this is only based on official inflation rates. So the reality is much more significant than this, okay? It felt like a $246,000 house. And that mortgage payment of $1,000 a month felt like $2,580 per month. In 2000, the $132,000 house felt, based on the official CPI, like a $214,000 house. And that $1,000 mortgage payment felt like $1,612 per month. And this helps answer the question, or at least make us think about, compared to what? As the Hartman Comparison Index really teaches us. That's the last presentation in Miami. So I won't keep you waiting too long. Here's a couple predictions. I think prices this year will go up about 12% for real estate, for income property. Now keep in mind, you can't compare this to the S&P or any other investment, because with income property, you're leveraging it. And leverage means debt. And debt is bad if you have to pay for the debt yourself. But with income property, we outsource or delegate the obligation of debt to people called tenants. And then we tell them, not only should you pay my mortgage for me, but you have to give me extra every month, and I'm going to call that positive cash flow. And so a lot of it, like the iceberg, a lot of the returns on income property is below the water, and they're not apparent to a lot of people. That's why it's so important to use the free software and watch that video and learn the math of income property. So many people, and I've seen this over the last 18 years of helping investors buy properties nationwide, so many people can be in a position where they think they're losing, but they're actually winning because they just don't know how to do the math right. They just don't understand it. So learn to do the math of income property. Rents, I think they will increase by 8%. Now, one question I hear a lot from our investors, and we have thousands and thousands of investors, is, hey Jason, if the rents keep going up so much, who's going to be able to afford to live in my property? $15 minimum wage, yeah, well that's true, and that'll push all wages up because it's a trickle-up economics. Hey, look, socialism is trickle-up poverty. That's a good quote. Say that to your friend and family member, Fred, okay? You know, socialism is trickle-up poverty. That's all it is, right? Okay, so as the rents keep going up, something has to give. And here's what gives. Just remember, the socioeconomic ladder, look at it like there's two ladders that are side by side. And these two ladders, people move up and down these ladders at different rates from different experiences. And we've seen this over the past 10 years, 20 years, right? If you talk to your tenant how many people own rental property now? Okay, yeah, most of the room. Smart audience here. Great, good job. So if you talk to your tenant today and you assess their standard of living, basically, and then you continue to own the same exact property, and you have a new tenant 5 years from now, and you talk to them and assess their standard of living and where they came from, you will likely hear that they moved down the socioeconomic ladder, that they used to live in a bigger house, in a better neighborhood, in a better school district, right? So people will just accept less. That's what gives. It's like moving from an inexpensive city to an expensive city. I mean, if you move to New York, you're going to live in a closet for the price that you could have a 3-bedroom, 2-bath suburban home in many areas of Florida, right? That's inflation. That's the standard of living going away. It's not going to be the same tenant in this house. It's going to be a different person who has moved down the socioeconomic ladder, sadly. And this is terrible, but it is the way it is. So I'm practical, all right? Okay, so how many people like Apple products? Okay, yes, all right. Apple's almost as disgusting as the other big tech companies, but not quite as bad. So Apple is the world's most successful company, right? And Apple gets a big share of our wallets. Every year they have a new product launch. They come out with a new phone, a new watch, maybe some new laptops, new stuff, new earbuds, AirPods, whatever, iPad. People buy them. So you probably spend a lot of money with Apple. How much do you spend? Do you buy a new iPhone every year and spend $1,500 or $1,200? Every 3 years, do you get a new computer and spend $2,000? You know, on average, if you're, and this, you know, this could apply to Samsung or whatever, right? It's just the point I'm making. How much money do you pay every year for your favorite tech brand? Maybe $2,000 on average per year? Anybody? You're going to raise your hands again? No? Yeah. Come on, you buy a new iPhone. I know you're buying a new iPhone every year and a half, okay? The statistics say that, right? So, and maybe you don't do it every year, but you do it every couple of years, so it averages out. So I just want you to think of it this way. Every company, every business, including your businesses, if you have your own business, wants to get a bigger share of the consumer's wallet, obviously, right? This is the goal, to get your customers to spend more with you, to offer them more products and services so they will open up their wallet and spend more with your company. Well, when you're a real estate investor, I want you to just really think about the share of wallet, the share of income that you get as an investor.
25 to 30%.
Oh, more than that. A typical tenant will pay 1/3 up to 40% of their income every month for rent. So that means for the first 12 days of every month, they're working for you. They're paying that money to your business, your rental property business. For the first 146 days of every year, until May 27th, they're working for you. Isn't that incredible when you think of it that way? They're paying down your mortgage. They're paying this money to you. Housing has the biggest share of income of any other consumable. So just realize how important this customer is to you and take good care of them because they're sharing a lot with you. Okay, so mortgage rates. They're the lowest they've been really in history. If you read this great book by the late David Graeber, it's called Debt, the First 5,000 Years. I didn't get to interview him on my podcast, but I did talk about the book quite extensively on my show before, and you look at some of George's really old charts, you'll see that we have well, I mean, not exactly, because we've had slightly lower rates in the past year and a half, right? But overall, we have the lowest rates ever, period. And this is toxic. I don't think this is a good thing. I think money has to have a cost to have a legitimate economy. If money doesn't have a cost, and there's no time value of money, you have a very dysfunctional economy. So I don't think this is good, but I do think you should take advantage of it. My prediction, mortgage rates will rise by about 0.75% this year. We'll see. I kind of think the Fed will do 2 increases, and they don't control mortgage rates directly, but they certainly influence them, and then they'll chicken out. They say they're going to do 3 increases, but I don't think it's going to happen. So anyway, but here's the thing, here's one thing that everybody's missing that nobody except yours truly is talking about. And this is really, really important. It is the hoarding of mortgages that is coming. There is going to be a significant hoarding of mortgages headed our way. One reason these low mortgage rates are toxic to the economy and the housing market is good for you if you're an investor, but for society, it's not good. Here's why. As George has told you many times, and I have told you many times, the mortgage is a huge part of the income property asset because you get the inflation-induced debt destruction, et cetera, et cetera. The mortgage is a big part of the asset. As mortgage rates rise, as they absolutely must increase. Who knows how quick it'll be, but it will happen. The people with the cheap mortgages locked in for 3 decades, the people that got a mortgage today that don't make the last payment until 2052. Just think of the significance of that. 2052. How much will the world change in the next 30 years? How much inflation will occur? How much of our freedom will be lost? You know, probably not looking great unless a new administration comes in. But the people with these cheap mortgages will hoard them. They will not want to part with their properties. They will beg, borrow, and steal to keep that cheap mortgage. So instead of moving, they're likely to renovate their house. If you're in the home renovation business or sell building supplies, it's probably going to be a pretty good business in the future. Or, well, it is now, obviously, but it's going to be even better in the future. As people stay put and they do whatever they can to keep these houses. Now, some might be shaken out by a big recession, but with these incredibly cheap payments, they're not likely to give up these mortgages. And this is going to exacerbate the housing shortage going forward because it will keep supply that should come on the market from coming on the market. And that will cause increased upward pressure on rents and prices and make the housing shortage even worse if they don't make it easier to build houses. So that's a big deal that nobody's talking about. Okay, so inflation-induced debt destruction, very, very important technique. Let me just show you how your different assets perform versus inflation, the strength of those assets. And I got to go through this pretty quickly. I'm running behind. I only got 2 hours left. So, so in the top, the green bar, these things perform the best against inflation. Now, updating this chart, I'd probably put Bitcoin in there too, okay? But the chart's older than that, where Bitcoin wasn't as popular when I made this chart. But, you know, gold certainly performs well against inflation. So there's Lynette's stuff. Mortgages perform really well against inflation because the debt gets cheaper to repay over time. The value of real estate hedges inflation very, very nicely. The income from your job, medium. Hopefully you get a cost of living increase. Rental income, medium. You know, the rent keeps pace with inflation, but it doesn't, you know, outperform it in any big way. Stocks, you know, hopefully the S&P goes up with inflation. And the things that just are trash are cash, bonds, pension income, and taxes, interestingly, because the IRS doesn't calculate inflation correctly. Most of the time it benefits them, but not always. With income property, it benefits us because they don't get it. Okay, I'm going to skip these next two because I want to get to this other stuff. But I go through and just listen to the podcast for, strength versus deflation and strength versus taxation. Okay, there's more to this. But let's get into the Hartman Comparison Index and look at a measuring stick for value. Okay, answering life's most important question: compared to what? Compared to what? So the index was something I created because I think this compared to what question is really the most important question of life. And we have to understand before we go into it that there are three types of markets, and most of you have heard me talk about this. There's a linear market, steady and profitable, boring, cyclical market like a roller coaster, and then there's the hybrid market that's in between the two. So we sell a lot of properties in Memphis. This is what a chart of prices looks like in Memphis, Tennessee. Very linear, has small declines, small increases. Overall, it's pretty nicely, in a good way, boring. Indianapolis, another big market for us. We've helped hundreds of people buy properties in these markets over the years, and very linear and boring. Now, my hometown in the Socialist Republic of California looks like this. Psychotic, right? That's Los Angeles. That is a cyclical market. It's a roller coaster ride. So we want to avoid these cyclical markets and gravitate toward linear markets. So the question I always say is compared to what? The question George always says is it cheap or expensive? So the Hartman Index, Comparison Index, answers these questions. Here's real estate prices versus gold. We kind of have to throw out 1970 because the price was controlled until 71. So let's just look at the year 2000. If you wanted to buy the median price house in the year 2000, it would cost 520 ounces of gold. If you wanted to buy the median price house today, it would only cost 196 ounces of gold. So, priced in gold, is it cheap or expensive? Cheap. Cheap, cheap, cheap. You sound like birds out there. Cheap, cheap. Okay, so oil. Oil is one of the most important commodities in the world, bar none. Doesn't matter what the tree huggers say, the world runs on oil. Okay? 1970, oil was $4 a barrel. It took 6,400 barrels of oil to buy a house. In 2000, it took 5,300 almost. Today, it only takes about 4,500 barrels of oil. So priced in oil, is it cheap or expensive? Cheap. Okay, good. How about rice? Rice is the basic food stock for 2/3 of the human race. It's important. Rice prices are very important. So in 1970, and I'm just picking some times here to get 52 years of history. You can look at any decade you want, okay? It took 42,000 hundredweight, which is 100 pounds, of rice to buy a house. 31,000 in 2000 and 25,000 today. So priced in rice, is it cheap or expensive? Cheap. Okay, Standard & Poor's. How many shares of the S&P does it take to buy a house? 1970, 249 shares. 2000, 112 shares. Today, 74 shares. Priced in shares of the S&P, housing is the cheapest it's been in 52 years. Now, Forbes has its own consumer price index. They call it the Cost of Living Very Well Index, okay? This is the rich people's CPI, okay? And we all have a different CPI. That's why it's a little murky and hard to calculate. So compared to the Forbes Cost of Living Well Index, housing is almost the cheapest it's ever been in 52 years, except for 2010, it was cheaper. That's how many shares of the Forbes CPI it would take to buy the median price house. Okay, how about haircuts? How many haircuts do you need to trade for a house? In 1970, 9,200 haircuts to buy a house. In 2000, 6,700 haircuts. Today, 9,800 haircuts. So priced in haircuts, housing is a little more expensive, isn't it? Yeah, only time I felt better about losing my hair. All right. The Goldman Sachs Commodity Index, the GSCI, is an interesting measure. 1970, the house cost 188 shares. By 2000, it was 46 shares. Today, it's 128 shares. Not the most expensive it's ever been. but it's more expensive certainly than it was 22 years ago, right, to buy a house. But who cares about the price of the house? That's not important. What's important is the payment on the house. This is mortgage payments adjusted for fake news inflation, the CPI. Now, know that in 1970, if you bought a house, your typical mortgage payment for that median price house would be $127. Adjusted for the artificially low CPI inflation rate, today it's $164. That's not bad, adjusting for house price, inflation, and interest rate. Right? Got it? Okay, but what if you adjusted for real inflation? Yes, the house is free. Just ask John Williams. Okay. How about ounces of gold to make your mortgage payment? I'm not going to go with 1970 because it's an anomaly controlled. 2000, 2.8 ounces of gold every month to pay your mortgage. Today, 0.7. Barrels of oil, 36 barrels in 1970, 28 in 2000, only 15 barrels today. It was cheaper 12 years ago in 2010 in barrels of oil, but it's pretty cheap today. Okay, how about shares of the S&P? How many shares of the S&P do you need to pay your monthly mortgage? 1970, 1.4, 2000, 0.6, today 0.3. How about average wage? How many hours do you have to work at the average wage to pay the mortgage? 41, 52 years ago in 1970. 22 years ago it was 69 hours. Today it's only 46 hours. Almost the cheapest it's ever been. I would call that a wash, actually, from 52 years ago. Interesting. So I tallied this up for you. And priced in gold, it's cheaper in 1970 and 2000. Oil, rice, S&P, Forbes Consumer Price Index, copper, no, not cheaper than 1970. We didn't go over copper, but it's on the chart. Yes, for 2000, 22 years ago, it's cheaper. Haircuts, no. Goldman Sachs Commodity Index, yes and no. And then the payment, there you go, it's yes, 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 except for hours worked, slightly more, but I would even give that a yes because it's a wash. So, is housing cheap or expensive? To know anything, we've got to compare it with something, because there's a massive amount of data in the price of anything. And if you've read that great book, A Random Walk Down Wall Street, okay, that tells you that the data is in the price. There are billions of people making decisions that price all of the things we just discussed. And as those billions of people make those decisions, you have got the best survey in the world. The real survey is the price someone will pay. That's the real appraisal. And that's what we share in the Hartman Comparison Index. There's a lot more to it. We've got a free white paper at hartmanindex.com. You can just go there and this will be emailed to you, this white paper. And I think it's like 17 pages long. It's got charts and graphs and all this great stuff. So you can read till your heart's content. And stay on our mailing list because we update the index quarterly. Some of the things for year end of last year, we had to do estimates because the data doesn't come out till the 15th. Literally, we're right on the precipice, but those are estimated, some of them. But the white paper will be revised as we go forward, and that's totally free for you at hartmanindex.com. Happy investing. Protect your freedom. Protect your family, protect those you care about, and share this message with the world. What we're doing here is not just an investment conference, it's a movement. This is a movement, folks. So share it with everybody, and happy investing.